Ladies and gentlemen, I think this will be the second time I'll be addressing FM with you guys, and maybe my other colleague may have also addressed one or two topics with you. And the first time I attended the FM class with you, we addressed the introduction to financial management, which we did, and I also dropped an assignment for you all to research on. And that assignment related to what I think was related to EPS, earnings per share. And so far, so good. Only one person was able to submit that assignment. So this was the assignment, earnings per share. Only one person was able to submit that assignment, and I give kudos to that particular person. I'm not going to force you to do assignments, okay? It's a matter of choice. We are all adults. Mine is to do my own part, okay? And I will make sure I deliver the best. Yours is to look to yourself and ask yourself, do I want to dash ICAN money again? If you wish to dash ICAN money again, don't do assignments. As simple as that. Now, what I'm going to be doing today is working capital management, okay, under your FM. So I want to address this 15% of your syllabus. Now, let me go up a little so you can see something. So we have 10%, which is financial management function and environment. We have working capital, which is 15%. We have investment appraisal, which is 25%. We have business finance, 20%. We have business valuation, 15. We have risk management, 15. So I'm working on this part B, which is 15. If God permits me, if I have you for about 3 to 4 classes, I should be able to finish everything relating to working capital management. Then I'll move to something else, maybe investment appraiser. If I have you 4 classes for investment appraiser, I should finish what investment appraiser is all about. Just that the investment appraiser at FM level is a little bit tricky, okay, compared to PM level. So we may need more time to address complex questions for investment appraiser. So let's dive into working capital management. So let me show you what we would be doing. Now, for working capital management, we have a lot to do. Now, we have working capital management. We have what we call a working capital cycle itself. We're going to be addressing that today. We're also going to be addressing this current ratio, inventory turnover ratio, sales revenue to net working capital. We'll address some ratios today. But the only thing that we will not do is that we will not move to C, which is EOQ, economic order quantity. That one is a topic on its own, which I'm going to be addressing with standard questions. All right, I'm going to be addressing that with standard questions. But whatever I'm going to be teaching you today is going to go a long way to address working capital management in general. All right, so we won't touch EOQ and we won't go further from that in this class. We'll do that in the next class. All right, so let's start with working capital management. I have provided this material. Do I have the material? Are you serious? Okay, interesting. Okay, a minute. So I need to display my own material. All right, so I'm just going to be doing a summary of working capital management. We'll take about 4 questions we'll solve. My questions we are gotten from ICAN study test and also from ICAN past questions. So I'm going to be addressing them today. Now, what is working capital? Let's just start. Normally, everybody knows working capital at your balance sheet level, isn't it? There's one definition of working capital at your balance sheet level. So that working capital that you know at your balance sheet level, just drop it one side. We'll need it, okay? We'll need it, but just relax. Let me explain what working capital is, and then we can now bring in your balance sheet level into it. Now, what is working capital? So working capital is the capital, or you call it finance, that an entity needs to support its day-to-day or everyday operation. That is working capital. Just interpret it with your word, operational capital. That's what it means. So the money that a business needs to finance its daily operation is working capital. Abi? So let's go further. They said to operate a business, an entity must invest in inventories and it must sell goods and services on credit. Now, the thing is that that money that a business needs now to, to run a daily operation, the question is, where did they get the money from? They will get the money from inventory that they sell. That's the normal thing. If I am trading laptops, that is where I'm going to get the money I'm going to use to finance the business. It's as easy as that. Therefore, inventory is one source of revenue or is one source of working capital. Does that make sense now? If we don't sell inventory, if we don't get customers that will buy our inventory, there's no way we can get working capital. The fact is that you cannot keep borrowing from the bank. Why would you be borrowing from the bank when you have a business that could finance your daily operations? Whenever you want to borrow from the bank, let it be that you want to finance a major operation or a major investment before you can start thinking of borrowing from the bank, something like that. Now, so therefore, going forward, they said holding inventory and selling on credit cost money. So therefore, that inventory that we're talking about, to hold inventory simply means to keep inventory in your warehouse. Keeping inventory in your warehouse costs money. Remember when we were looking at the ICAN material for the working capital, I told you that there's something about EOQ, economic order quantity. That economic order quantity is also part of working capital management. That is where we begin to ask ourselves what quantity of inventory should a company order and keep in their warehouse. Any quantity of inventory that you're ordering and keeping in your warehouse, it costs you money. Because that quantity of inventory that you keep in your warehouse, you put security man at the gate. But everybody is scared. Look, somebody should not go and break my gate one day and go and steal all my ACs that I put in my warehouse. Look at ShopRite. If ShopRite is closing, their generator is still on or light is still on because why? Most of their products need refrigerating. If they don't refrigerate it, it will spoil. So if you keep inventory, it costs you money. I make sense now. So keeping inventory costs you money. Selling on credit also costs the company money. Because when I sell on credit, what it means is that you did not pay me. I mean, I need money to run my business. I'll go and borrow. And when I borrow, what does that mean? I'll be paying interest on it. That is costs. But if I sell to you, you pay me money, there will be no need for me to go and borrow. So it doesn't cost money when you pay me in cash. So when I hold inventory, that is expenses on my own end. When you decide not to pay me also, it's an indirect expenses on my own end because I will go and look for money to source and run my business. So when we are talking about working capital management, we're not just talking about the day-to-day running of the business or the money you need for the day-to-day running of the business. We're also talking about how you can get that money, how you can manage the inflow of that money. So working capital is the money you need to finance your daily operations. And how do we get this money? We get this money from inventories that we sell. We also get this money from customers that owe us, which we call receivables. Don't forget, we also get this money from payables. Payables are people that supply us. So how do we get money from payables? It's not like we will just walk up to our suppliers and say, borrow us money. Okay. Yeah, you used to supply me laptop now, borrow me 2 million. No, we don't need to ask them to borrow us money. What we can just do is to tell them that, okay, can you supply me these laptops on credit? You understand, for like 6 months or 3 months, I'll pay you. For them to give it to you on credit, that is also a source of working capital because normally you're supposed to go there with cash. But since you don't have cash, you went there and they gave you the money. They gave you the product. That is a source of working capital. So just in case you see it in your examination, sources of working capital from the sale of inventory, okay, from customers, that is from debtors, and also from payables. These are the basic sources of working capital. So let's go forward. You see, finance required for operations can be gotten from suppliers or bank overdraft. So I've explained suppliers, okay? So your bank can also give you an overdraft, all right? You have been doing business with them. Their own is not just to be collecting money from your hand. They should be also able to assist your business in one way or the other. So bank can also give you funds, okay, an overdraft. An overdraft is a short-term fund. So an overdraft can also be a source of working capital. Does that make sense now? Now let's go forward. Then I said cash and short-term investments are also elements of working capital. Cash and short-term investment are also part of working capital. Does that make sense? Let's go on. I will tell you why. Now, some cash might be held for operational use to pay liabilities, while surplus cash in excess of operational requirements might be invested in short term to earn some investment. So cash is also a part of working capital because I think cash is the most ready form of working capital that we have. If we say that inventory is part of working capital because when we sell inventory, we can finance our business. Therefore, cash, which is already in liquid form, is also a working capital because when the cash is already in liquid form, we can use that cash to finance our business. Now, when you have excess cash, all right, and you put in some to finance your business and you still have some remaining, as a wise finance person, you are not supposed to leave cash in your bank. Okay, you're supposed to take that cash and invest in short-term investment. You can invest in treasury bills, you can invest in bonds, you can do some kind of, you can lock the fund for like 3 months, 4 months to get money. In fact, there's a general saying that good financial managers do not help companies to accumulate money in the bank. So what they do is that when they see that their bank account has money, they pull out that money and look for investments that will multiply that money. That is why sometimes when people tell me I have 10 million in my bank account, I just smile. The rich dudes do not really have that much in their bank account, but they can actually point out investments that speaks for them. They can point out landed properties. They can point out shares holding in company, but you are just saving money with banks, saving money, and bank is collecting your money and collecting interest. So that's just it. So these are just the concept of working capital. Now, how do we view working capital? Okay, working capital can be defined from two different perspectives. Either you are defining it from the net concept perspective, or you are defining it from the gross concept perspective. It's as simple as that. Okay, so if you are defining working capital from the net concept perspective, invoking the idea you already have in balance sheet, that will not be your current assets, less current liabilities. It's as simple as that. Your current assets are the assets that you have now to run your business. They are assets that will last for 1 year, okay, which are giving you funds to run your business. Now, when you take out your current liability, what are your current liability? Your current liability are simply the debt that you need to pay people within 1 year. So, for example, if my current asset, meaning what I have is 10,000 naira, okay? If I have 10,000 naira in terms of current assets, and I'm owing somebody or I'm owing a group of persons 4,000 naira, it simply means that I have 6,000 naira left, which I can actually bring my business to run. That is the concept. So current assets of a company less its current liability amounts to net concept of working capital. Now, why do they call it net? It is called net because we are taking out current liability out of current assets. Okay, we are taking out current liability out of current asset. That is why it is called net. Does that make sense now? So it is also called net current operating asset. Anyhow, I can want to bring the name. Net current operating asset. That is another name for the net concept of working capital. I hope we are communicating. Now, what about if you want to define working capital from the gross perspective? Now, from the gross perspective, for something to be gross, it means that you have not yet deducted something from it. Okay, that's the meaning of gross. So gross weight, net weight. All right. So the gross concept of working capital means this concept views working capital as a firm's total investment in current assets. It means all your current assets, all the amount you have in your current assets simplifies or signifies your gross concept of working capital. All right. All your current assets, your cash, your debtors, your what do you call it, your bank, you understand, your inventories. Those things are your current assets. So all the money you have invested in them together called gross concept of working capital. While for the net, once you take out the people you are owing from that current asset, it becomes net concept of working capital. Anyhow you would like to explain it for ICAN, just ensure that you are able to display high level of what knowledge in this concept. Now let's go forward. What are the objectives of working capital management? Now, we have explained what working capital is, which means the money you need to run your business on a daily basis. This is different from working capital management. Okay, WCM. Management has been added to the what? To the definition. Why? So this is very simple. If you say that working capital is the money I need to run the business, therefore there should be a framework or something that will help us to manage this money. Because if we are not able to manage these things, we cannot actually take our business to the next level. It's as simple as that. So just like saying your transport fare is 10,000 naira per week. That is your transport fare. Okay, that is your working capital for your transport to your work. Now, your transport fare management will now be your ability to manage that 10,000 so that at least you will be able to spend that 10,000 and nothing more than the 10,000. So when we're talking about working capital management, we're talking about the whole aspect of financial management, okay, which is concerned with ensuring that the investment in working capital is not excessive and also ensuring that enough working capital is available to support operating activities. When you see a job and the job title says financial manager, okay, finance director, don't rush to apply because you know how to prepare financial accounts. You are just simply on your own. It goes beyond those kind of calculation. It goes into financial calculation. Now, that leads us to this working capital management. It says that working capital management talks about everything that a manager should know okay, regarding to financial management, okay, regarding to those elements that makes up working capital. And I've mentioned those elements before. I've mentioned cash, I've mentioned debtors, I've mentioned inventories as the elements that makes up working capital. So how do we manage them? Number one, when you're trying to manage them, you must ensure that the investment in working capital is not excessive. You don't over-invest in working capital. Samuel, please stop annotating on my screen before I send you out. Who is that? So you don't over-invest in working capital. Now, when I use the word over-invest in working capital, at the back of your brain, replace working capital with inventory. Okay, replace working capital with inventory, which are the elements. We replace working capital with inventory, replace working capital with receivables. Just replace it with the element of working capital. It's as simple as that. So you do not over invest in inventory. That's what it means. Or you do not over invest in receivables. That's what it means. So why would you say we should not over invest in inventory? I think if we have inventory in our warehouse, we should be able to meet up with demands. Mm-hmm. So therefore, why did you say we should not overinvest in inventory? Now, the answer is very simple. At this level of your career, you should think outside the box. Okay? We do not overinvest in inventory. It's a simple terminology that means that you do not overstock inventory. There are some products that when you stock them, okay, you may not even have demands to cushion for that. Demand may not be sufficient for them to buy everything. Sometimes you just stock them like perishable products. These products will even get spoiled. You will lose money. So why stocking perishable products or why stocking products that you end up losing money? Why stocking products that will end up making you to incur more costs? Why would I put goods inside my warehouse and it will take me months for me to sell those goods? It's unreasonable. So keeping goods in your warehouse or over investment in stock is what we call capital tied down in finance. Okay. Over investment in stock is what we call capital tied down in finance. It means that you just took your capital and go and tie it in inventory and be waiting. Let customer come. If customer did not come, you will come and borrow money from me. I'll be giving you to buy gari and granules to drink. Until customer will come, you will sell and you will get money. Okay? And before you know, you use that money again to incur expenditure. Because sometimes your product may not be fast moving. That's one thing. So as a finance manager, your advice is that let us not over invest in inventory. That is why we usually ask our EOQ experts to always calculate what they feel we should be able to produce. Okay, so that we will not overproduce. That's just it. We will not overproduce. That's it. Now, let me give you a real life scenario. When you, your wife, and two kids stay together, there's a quantity of products that you need to buy in the house, like Indomie. You can just buy like 2 cartons. Maybe you want to buy garlic, you can buy like 4 pins because you guys are four. But trust me, if your kids go for holiday with your parents, all right, just you and your wife, and you want to stock, you will not be looking at 2 Indomie. You can just buy 1 pack of Indomie, one pint of Gary. That is management. Okay. So you are looking at the demand for you to what? To plan yourself. It's as simple as that. So please, this can be a theoretical question that will challenge you in your exam. You do not over invest in working capital. And you can tell ICAN an example of working capital is inventory. Tell ICAN why. Okay, because storing inventory in a warehouse costs you money. You will pay for rent, whether customer buys or not. You will pay for electricity, whether customer buys or not. That gateman that sits over that place and watch for your product, you will pay them. Okay. You will pay for some kind of local government bills that will come to you. You will pay for them, whether customer buys or not. Now, that now leads us to a concept that was introduced in Japan. That concept was known as JIT, just in time. Okay. Just in time. All right. So the just in time approach, it simply means that we should make products when we have customer that wants to buy the product. Don't make product and store it in your warehouse. Make it when the customer is demanding for it. So therefore, if I am making power banks, okay, I wouldn't make power banks and store in my warehouse. I would wait until I have orders. Okay, so when I have orders, I would now make the power bank and then give them directly. So therefore, I am eliminating the cost of storing this product in my warehouse. However, there are some things that needs to be done before you can operate just in time. But that is not a discussion for today. We will still look at just in time in full, and I'm going to embrace it, okay, in its entirety. So let's proceed as with this same material. Then the next point is ensuring that enough working capital is available to support operating activity. Look at that word, ensuring that enough working capital is available to support operating activity. So it means that you don't need to have excess, just have what is needed to support your daily activities. It's as simple as that. So these are the objectives of working capital. Number one objective is to ensure that that the investment in working capital is not excessive, it's not too much. Number two objective is to ensure that you have enough working capital, okay, or enough working capital is available to support your operating activities, meaning your daily activities. Now let's go to the next subheading that states investment in working capital. Now, whatever I want to say here, I've already explained it, but let me just read it out. Over investment in working capital, as if you overput money in working capital. And I told you at the back of your head, let the working capital be interpreted as inventories or trade receivable. Now, when you overinvest in working capital, what does that do? It reduces profits or returns to shareholders. Definitely. When you overinvest in working capital or in inventory, it reduces your profits. How? Won't you pay rent? More rent will be paid, salaries will be paid to security guards, more consumption of power will be paid. So the more you store inventories, the more you overinvest in them, the more your profit line will be reducing because you have to incur more expenses to keep that. For example, people that even keep beans in their store, okay, I think many of them say they usually buy pepper again to prevent the beans from all these termites and stuff like that, all these their beans eaters also. So imagine, so they are even spending money to preserve their own products. So that's going to reduce your profit. So this is because, okay, the entity is incurring a cost, the interest cost of the investment without obtaining any benefit. Now, another way you can view this is that imagine that you borrowed money to even buy the inventories and put in your what you call it in your store, and customers are not coming yet. You overbought inventories. You'll be paying interest on the amount that you borrowed now. So that is also another cost of what investment. Does that make sense now? All right, so let's move further. The next point says that underinvestment should be avoided because it creates liquidity risk. Now, for the fact that I said that overinvestment is not good, does not mean that you too should go and underinvest. Okay, if you underinvest in inventory, in working capital, when customer comes, you may not see goods to supply them. Does that make sense now? So if working capital is low, there would be a risk of having insufficient cash and liquidity. So when you don't have much working capital, when you don't have enough working capital, okay, you are going to also face risk. So the idea is when you have too much, there's a risk. When you have too low, there's a risk. Then there comes this question. What is the question? I give you the question here. The question is, what amount should be invested in working capital? Okay, that is what it means. So if you say, if I overinvest, if there's a risk. If I underinvest, there's a risk. Then the question is, what amount should I now invest in working capital? There is no straight answer to this question, but the amount that you should invest would depend on the trade-off, okay, between the benefit of having sufficient finance to support trading operations without excessive liquidity risk and the cost of financing the working capital. Now, I'm going to be leaving this maybe after I am done because I have something to say here. I don't want to bore you too much with a lot of theory, okay? So this one here that I'm leaving is what is the adequate working capital that a company should have? You can expect this kind of question in your exam. Okay. How does a finance manager determine the adequate working capital that its business should have? This is simply the answer I have given to you here. There is no direct answer to it, but it depends on the trade-off. Okay, the trade-off, the set-off, okay, between the benefits of having sufficient finance to support your trading operations without excessive liquidity risk and the cost of financing a working capital. Let me leave this. I'll come back to it later. Now, what are the benefits of investing in working capital? Number one, investment in working capital, e.g., inventory, will allow the entity to supply its customers on demand. Yes, if you invest in working capital, that is to say, if you buy inventories in your store, it will enable you to supply your customers as they need it. Okay, I need 50, I need 20 a day, take. But when you don't have now, you can say, come back 2 days or 1 day and next tomorrow or tomorrow. We don't bring and come because why? You want to go and order it, okay, to get it. Next one is that on that benefit is that investment in working capital, e.g., trade receivables, help to retain an entity customer and keep the entity competitive. When we invest in trade receivables, it means that we are able to give credit to customers, like what Pathfinder does. So Pathfinder says, okay, if you don't have all your tuition fee, you can pay 80% today and pay 20% tomorrow. It simply means that Pathfinder invests in working capital. And what kind of working capital do we invest in? We invest in trade receivables. So what will this do? This will enable people who do not have all the funds to still partake in their classes. This will help to keep our customer base intact. That is investment in trade receivables. Then finally, it is also useful for an entity to have some cash in the bank to meet demands for immediate payments. Remember that cash is also a component of working capital. So when you invest in cash, it simply means that you have cash in your bank. Okay. So it is good that you don't have all the money in your bank and go and invest in shares or put in one investment. You should have something in your bank at least that will be able to meet immediate payment of anything that comes on board. So these are the benefits of working capital. Please take note of this. Okay, so this is disadvantage of excessive investment in working capital. I've looked into that before. I told you that, note that money tied up in inventories, trade receivables, and current bank accounts earns nothing. Any money you put in inventory that is not selling, any money that you give to receivables that is not paying back, and any money you put in your bank account that is not multiplying, they don't add any value to your company. Therefore, investment in working capital therefore involves a cost, meaning that for you to invest in working capital, there's a cost that you must incur, isn't it? So what is the cost? The cost of investment in working capital is the reduction in profit that results from money being invested in inventories, receivables, and or cash in the bank account, rather than being invested in wealth-producing assets and long-term projects. So when you invest in working capital, it reduces your profits, okay? So it reduces your profit because you'll be spending so many things to invest, rather than you investing in wealth-producing assets and long-term projects like shares, capital project, lands, properties, and the likes. Am I making sense now? All right, so thus, annual cost of working capital investment. The formula to calculate the annual cost of working capital investment will be the average investment in working capital multiplied by the annual cost of finance. This is the formula to calculate the cost of working capital. Just in case you are being asked to calculate the cost of working capital. Okay, so what is the investment that you have made on working capital? 10 million. That's what it means, 10 million. Multiplied by, what is the interest rate? Did you borrow the money? We're assuming that you borrowed the money, so you are paying 10% interest. Okay, so that will be 100K. That is your cost of working capital. There's no rocket science there. Just determine how much you have invested in the working capital and multiplied by the finance cost or interest cost given to you. It's as simple as that. Now let's come to the big boy where ICAN will, we're coming to where ICAN will text question. I'm not going to be looking at all. So determining the level of working capital. Okay, there's something I want to look at. Now this is working capital circle. Okay, working capital cycle. So let's look at this, determining the level of working capital. Now, the target level of working capital investment in an organization is a policy decision, which is dependent on several factors, including the length of the working capital cycle and management attitude to risk. When managers want to invest in working capital, okay, whenever they want to invest in working capital, they can look at what is the length, how long should we invest in working capital? And what is our attitude to risk? Okay, you must have done this at CSME level for people that have done CSME. Management attitude to risk. Because when you invest in something and there's some people that like taking risk, it really means that they love risk. And people that don't like taking risks, they are risk averse, okay? They don't like risk. So whenever you are a manager and you're trying to make a decision, you must ask yourself, what is my attitude? Do I love risk? Am I neutral or am I risk averse? That means you don't like risk at all. It is based on your attitude that you will not decide which policy you should follow. For managers that love risk, they will want to buy a lot of inventory. They will not want to put inventory in their warehouse at all. That is it. But managers that do not like risk, they will put inventory in their warehouse on the assumption that anytime a customer can let them come and buy. But managers that love risk, they will say, no, let's wait until the customer comes, okay, before they buy. So I'm going to be explaining those two concepts now, okay? I am taking time to address these theories because of financial management. Financial management is not all about solving. You'll be able to give financial verdicts, okay, on some kind of policies, on some kind of terminologies. That is why I'm taking time to explain this. So please stay with me. Do not expect that your full examination is going to be calculation only. So I have said for managers to invest in working capital, they ask themselves, what would be the length of the working capital? That's the reason why I want to do that. Okay, if I want to invest money in in Alajo or in Ajo or Susu, I will ask how many people are there. If they say there are 20 persons, that means 20 persons will pack. No, I'm not ready. I can only do 5 persons. Let 5 persons pack. If 5 persons are packing, it's shorter for me. So we want to know the length of working capital. I also want to know whether managers, what is the manager's attitude to risk. Now, okay, so before we look into that, let us look at working capital cycle. That is the working capital cycle. That is the length of the working capital cycle. Now, what is the concept of working capital cycle? This one measures the time taken from the payments made to suppliers and raw material to the payment received from customers. Now, let me give you an example, okay? Now, in case it comes out in your exam, if you explain the concept of working capital cycle, which is usually their bottom line whenever they want to ask questions, working capital cycle, even at SFM level. Now, what it means is that the time it takes you to pay the suppliers that you bought goods from, okay, and down to receive money from your customers is what we mean by working capital cycle. Now, let me put it this way for simplicity, right? When we talk about working capital itself, I gave you 3 elements. I gave you many elements, but 3 are key whenever we are computing. What are the 3 key ones? Inventory, receivables, payables. Okay? Inventory, receivables, payables. These are 3 key when we are computing. So they are trying to tell you that the time that it took you, okay, the time taken from the payment made to supplier, the time that we pay this guy, the supplier, down to the time that our debtors are paying us, is what we mean by working capital cycle. The fact is that we bought goods from our supplier on credit. That is meaning of when customers are financing us as a company, isn't it? That is working capital. So we told them that we don't have money, or we didn't even open up to them. We maintain our steeds. Okay, supply us 200. This thing will pay you next 2 months. Say no one, you my party supply. Okay. The customer came and said, okay, I won't buy. As a good customer, just give me 100 packs, but I'll pay you next month. They say, no, wahala, to maintain relationship. You are owing your supplier, your customers are owing you. I get it now. So the time it took you to pay your supplier, if it took you 3 months to pay your supplier, and your customer, it took them 1 month to pay you, the distance between this becomes your working capital cycle. Okay? Becomes a working capital cycle. So we are trying to measure what's the distance. The fact is that I would allow my customers to pay me earlier so that I can gather the money to pay my suppliers. But what about if I gave my customers 3 months to pay me, but my suppliers gave me only 2 months to pay? Look at that tactics. My customer bought from me, and I told them, okay, you can pay me in 3 months' time. But my suppliers that I bought from saying, okay, you can pay me in 2 months' time. Where would I see the money to pay my suppliers? Because all the goods I have sold, they are with my customers and they are not ready to pay me until 3 months' time. So where would I see the money to pay my suppliers? That is where I will now begin to go and opt for bank overdrafts. I'm making sense now. Begin to opt for bank overdraft, collecting overdraft from bank to pay my suppliers, waiting for my customer to pay me the next month. So we need to understand the circle. Are we getting money first from our receivables to pay our suppliers, or are we, paying our suppliers first before receivables? That is what we are trying to calculate as your working capital cycle. Am I making sense? Please, you can reach out to me via the chat box. Okay, you can reach out to me via the chat box. So, are we making sense? So, as a finance person, you should be able to study this. Okay, not just say, I give you credit, I give you credit, no, you have people you are also owing. You have people you also want to pay. So, you must also ask yourself, how do I maintain a balance? Okay, so that I can have more cash to pay whosoever I am owing. That is working capital cycle. Does that make sense now? The cycle means, the rotation. Okay, the rotation, that is the cycle. Now, the next point there was the management attitude to risk, which is this management attitude to risk. Now, high levels of working capital are expensive, but low levels of working capital are high risky. Yes, if you keep high level of working capital, it is very expensive because you are buying too many goods. But if you keep low level of working capital, it is highly risky because if customer comes, you can't supply them. You only have few stocks, and if you don't take time, you will lose your customers. So that will not mean that we have an aggressive working capital policy or a conservative working capital policy under the management attitude to risk. Okay, so a manager can either have an aggressive working capital policy, can either stipulate or put into effect an aggressive working capital policy or can put into effect an aggressive working capital policy. If a manager is applying aggressive working capital policy, what does that mean? What does it mean? An aggressive working capital policy will seek to keep working capital at a minimum, meaning we don't want to invest too much, we invest small. Look, it leads to low finished goods inventory, meaning that inventory will be small, low raw material inventory, raw material will be small. This policy is adopted, okay? This policy is adopted by risk-seeking managers. Any manager that tries to keep things small is risk, okay? Is a risk-seeking manager. His attitude to risk is that he seeks risk, he like risk. So as a risk-seeking manager, we adopt an aggressive working capital policy, which is aimed at keeping working capital at minimum. It will be minimum, okay? Even if you want to give credit to customers, it is minimum. I get it now. Everything is minimum. But what about a conservative working capital policy? For a conservative working capital policy, this one is aimed to keep adequate working capital for the organization needs. So this one is not keeping small, it's keeping the one that is sufficient to run the organization. What this means is that inventories are held at a level to assure customers will be supplied. We will keep enough inventory that will meet customers' demand. And stock out will not occur. Stock out simply means when we don't have stock. So there's no way that we will run out of stock. That's what I say. And stock out will not occur because we have sufficient inventory to take care of our customers. Also, suppliers are as well paid in time. We don't tell suppliers that will pay you in 5 months, in 7 months, in next year. No. If we buy from you, give us 2 weeks or give us 1 month. We'll pay you in time. Unlike aggressive policy, suppliers can wait for 4 months. It does not concern us. 5 months, 7 months. That is aggressive. You are taking risk because that supplier can say, this man don't know me. If that supplier sees another person that will supply him and pay him cash, he will forget you and be giving all his products to him. So for conservative, you pay your suppliers in time. Now, this policy is mainly adopted by risk-adverse managers. Okay? People that don't like risk, they are risk-adverse managers. I'm going to stop here and entertain questions for just 1 minute. Just 1 minute. And if there's no question, I will just proceed. If you know that your background is noisy, please do not unmute. But if you know that you have a quiet background, please, you can kindly unmute. Any question, please? Any question, please? Any question?
Good evening, sir.
Yeah, good evening.
Yes, I have a question, sir.
Please proceed.
Okay, sir. I just want to ask the correlation between working capital and retained earnings.
Working capital and retained earnings.
Yes.
They are far. Okay, that's a good question anyways. Retained earnings is that part of your earnings that you went to keep. You get it now? You went to keep
Yes.
it, you retained it. Now there are 2 ways. You can retain it to, you can retain a profit and use it as working capital. Why sometimes you can retain a profit and use it for capital investments. It depends on your motive.
Okay.
Are you getting it now? But you see, working capital, the one that we know that we usually use every day. We don't need to wait till the end of the year before we retain it. We need it for everyday management.
Okay. So the second leg of it is that what if last financial year, we have some retained earnings? Now, can we say in a way that source of working capital can also be part of retained earnings? Probably we have retained earnings for last year, and we have not invested in capital investments. So we just take part of it for working capital. Can we say it's part of a source of working capital for the preceding year?
Now, the simple answer to that question is that what gave rise to that retained earnings was because you sold inventory.
Yes.
So that is it. So that is inventory. You sold inventory, that's why you have money that you can even retain.
Yes.
And you got money from customers, that's why you even have money that you can retain.
Okay.
So what are we talking about? Are you getting it now? So retained earnings is a concept that means that because the fact is that even as a financial reporter, You guys put retained earnings in your balance sheet. If I should ask you, go and open your bank account and show me the retained earnings, do you have it? No, answer me. You don't have it now. That's the question. You don't
You
have
don't
it.
have it, yes.
So why should that be a source of working capital? So are you
Okay,
getting it now?
thank you.
Uh-huh. Any
Yes,
other
very well.
question?
Thank
You're welcome.
you, sir.
All right. Any other question, please? Okay, so I want to assume that should be the only question for now. So give me a few minutes. Let me do justice to the other theoretical part of this material. Now, the next part of it is financing working capital. Okay, how do you finance working capital? So we have short-term and long-term finance for working capital. Okay, all right. So A is working capital may be permanent or fluctuating. Let me explain that. So what do you mean by permanent working capital? Now, this refers to the minimum level of working capital which is required all of the time. It includes minimum level of inventory, trade receivables, and payables. Now, working capital can also be seen as a permanent working capital or fluctuating working capital. Now, let me explain, and some people will be able to relate this to their daily activities or to their company. Now, if, for example, to run my business on a yearly basis, I already know my statistics is 10 million. That 10 million becomes my permanent working capital. Am I making sense now? Now, hold on. What do you mean by fluctuating working capital? They say this refers to the working capital which is needed or required at certain times in the trade cycle. I know that to run my business is 10 million. I've done my focus for salary. I've done my focus for fuel. I've done my focus for maintenance. In fact, I have a very good guy that studied financial data analytics from Pathfinder, and the guy has done it. 10 million, all things being equal. But there are some certain things that may occur that will require me to spend above 10 million. I'm going to give you an example. All right. I'm going to give you an example. I think I included an example there. Let me see. The amount of working capital needed on a normal business day will be quite different from the amount of working capital needed when a business is experiencing seasonal demand. Thank you. So I did that there. Boom or trade recession. Good. Now, 10 million is what I need on a normal day to finance my business for a year. But the way it is now, the economy is not making sense at all. The business is now in its peak period, e.g., umbrella company. This period that rain is falling now, umbrella company working capital has increased beyond their permanent. Normally, for umbrella company to work, for example, is 10 million naira. But when they get to rainy season, sir, they cannot use 10 million naira for working capital. What will they do? They will increase their working capital because they need to produce more umbrella and meet up with maxis. They can increase this working capital to 20 million. This 10 million that will make them to operate on a normal day is permanent working capital. The extra 10 million becomes the fluctuating working capital. It is called fluctuating because it will remain. Once you pass that season, you go back to your normal 10 million. Am I making sense? Am I communicating, please? So the normal capital that you need to run your business, all things being equal, is permanent working capital. But when there are some seasonal variation, economic boom, demand variation that will now make your business to invest more to meet up with those things, the additional you are investing will now be referred to as fluctuating working capital. Am I making sense now? I believe that is very clear. All right, going further, we'll look at the cash operating cycle. We are already getting to calculation already. All right, so that's your calculation part. So for those of you that are already dozing, please, this is the time that you need to listen so you can understand. We want to move to calculation. An important way of assessing the adequacy of working capital and the efficiency of working capital management is to calculate the length of cash operating cycle. So in your exam, if it's calculation, expect that ICAN will tell you that, hey, calculate the length of the cash operating cycle. This is what they will always tell you to calculate. Okay? So calculate the length of the cash operating cycle. What is cash operating cycle? The cash operating cycle is the average length of time between paying suppliers of goods and services received to receiving cash from customers for the sales of finished goods or service. I've explained that before. Okay, the time it will take you to pay and the time it will take you to receive. That's your cash operating cycle when you are receiving money. Okay, so the cash operating cycle is linked to the business operating cycle. Now, a business operating cycle is the average length of time between obtaining goods and services from suppliers to selling the finished goods to customers. So in case I can ask you to differentiate between cash operating cycle and business operating cycle, the difference is cash and goods. For cash, we're looking at the time it will take you to pay your suppliers and to the time it will take your customers to pay you. But for business operating cycle, we're talking about the time that the length of time between you receiving goods, not cash, receiving goods from your supplier, and the time it will take you to sell the goods to your customers. Some goods can be in your warehouse 2 months, 3 months, 1 year. People that sell cars, how far? They know now. They can have cars in their garage. 1 year, they've not sold that car. Their business operating cycle can be very slow. Okay, can be very slow. And sometimes when your business operating cycle is slow, it will affect your cash operating cycle because you can't get money to pay. Does that make sense now? That's why we said that the cash operating cycle is linked to the business operating cycle. Does that make sense now? So let's come down. What are the elements of your cash operating cycle? I've said that before. The average length of time for inventory. So inventory is one of the elements. What again? The average length of credit given by customers. So debtors are part of your element. And the average credit period taken from suppliers. Suppliers are your element. Please, if you have your pen, jot it now. When you are asked to calculate your cash operating cycle, you need three things. You will need to calculate for inventory, calculate for debtors, which is your customers, and calculate for suppliers. I've mentioned that before. So therefore, if you're asked to calculate your cash operating cycle, you need to calculate three major ratios. There are three major ratios you will calculate for you to get your cash operating cycle. The first ratio is your inventory, average inventory holding period. That's the first ratio. Okay? Average inventory holding period. That is the first ratio you will compute. The next ratio is average trade receivables collection period. Average trade receivables collection period. That's the other ratio you're going to compute. Don't forget that the final answers for these ratios, they are measured in either days, weeks, or months. Not in money, they are ratios, okay? And they are computed, their final answers usually in days based on the question, in weeks based on the question, or in months based on the question. So put it here. So let us say 5 weeks, 6 weeks, you add both together, that will give you this. Then you take out your average period of credit taken from suppliers or average trade payables period, anyhow you want to call it. You deduct it. Once you deduct it, your final answer is going to be cash operating cycle. Okay? Why are you adding these two? Eventually, if you sell inventory, you get money. From your receivables, you get money. So we are adding these two together because they are sources of their inflows. They will act as inflows to our what? Our working capital. But why are we subtracting payables or suppliers? It means that we are paying them money. That's why we are subtracting it. So what is the days that is left is our cash operating cycle. So you need to calculate three ratios. I'm going to give you the formula to calculate these three ratios. Once you know this formula, life becomes easy for you. Okay. Now, before we move to the formula, please note, if I can give you a question, be very careful. Check the question. There are two things you need to determine. One, is this company a trading company? Number two, is this company a manufacturing company? The way I have given you this format now to prepare cash operating cycle, okay? If it's a trading company, it is different from when it is a manufacturing company. I am telling you now, so you pay attention. Before you will tell me that you open one past question, the way they solve it is different from the way they solve it on that past question. This is the key. If ICAN gives you a question to calculate cash operating cycle, okay, I told you there are three ratios you need to compute. The first one is inventory ratio. The other one is collection, receivables collection period ratio. While the last one is what? Payables payments ratio. And for you to even calculate this ratio, you must ask yourself, is this question, the name of the question that was tagged, is it a trading company or is it a manufacturing company? So let's move. So measuring cash operating cycle for a manufacturing company. Okay, let's bring it down. Where's the format? Did I do that? Okay. So for a manufacturing company, the difference is the same thing, no? Is the same thing to God and man. It's the same thing. The only difference is this inventory that is here. Please pay attention. The only difference is this average inventory holding period. That is where the problem is. Why? Because for a trading company will only keep finished goods inventory. But a manufacturing company will keep raw material, work in progress, and finished goods. That is where the problem is. When you see this receivables collection period is the same thing. You see payables suppliers payment period is the same thing. But when it comes to inventory, if they give you the question is for trader, is for trading company, just know that your average inventory holding period will be only for finished goods. But if the question is tagging as manufacturing, just know that your average inventory holding period, that is the number of time it takes you, the period it takes you to hold inventory, to keep inventory, is going to be both for raw material, work in progress, and finished goods. That is the only difference. Just in case you are going to ask yourself, what are the formulas for this thing? I am very nice, okay? By the message of God, I have given you the formula. Okay, the formulas are already in this material. And in fact, these are formulas that you have already known from FRO time. Okay, so let's go. For inventory turnover period, or what we call average inventory days, or average time for holding inventory, or inventory holding period, I gave you different names. Anyhow, they want to use the name. This is the name. This is what it means. The formula will be inventory, or you say average inventory, and you divide it by cost of sales, and you multiply it by 365 days. Does that make sense now? If you want to calculate, your average inventory days, or your average time for holding inventory, or your inventory holding period, the formula you need is average inventory divided by cost of sales multiplied by 365 days. If the question is given to you in months, multiply it by 12 months. So you have to be logical. Don't go and say, Dr. President said it's 365 days. If the question was given to you in months, just multiply by 12 months. If it's given to you in days, multiply by 365 days. Please be careful. The question can even tell you that the days is 366. If the question tell you that the days to be used is 366, don't go and quote me. I will not hide my face. Use 366. Okay? I am using 365 because that's the general. Okay? But if the question gave you a day or the number of days to use, please use that number of days. It's very simple. Now, how do you get your average inventory? Just say opening inventory plus closing inventory divided by 2. That's the formula for your average inventory that you have up here. Am I making sense now? Now, this formula is only for trading company. Okay? Trading company. So when you now move to manufacturing company, you will now need to break down your material, your inventory into raw material inventory. This production cycle simply means work in progress inventory. Then this finished goods now simply means what? Finished goods inventory. So we need to break it down into 3 and get the final answer. Okay, that's what it means. So I'm going to give you just 3 seconds to brainstorm what I've taught you right now, and I will be right back. Just a few seconds. Thank you. All right, so for manufacturing company, you have to calculate for raw material, calculate for production cycle, which is work in progress, and calculate for finished goods. The formula has also been provided here. What is the formula for raw material? Okay, the same thing. Just use this pattern that is here that we used here. So the same thing, average raw material. Okay, just focus on raw material. Average raw material. Okay, divided by annual raw material purchase. So you are going to be using purchases rather than cost of goods sold. Okay, you're going to be using purchases. But the fact is that if purchases is not given to you in the question, please use your cost of goods sold, because purchases is inside cost of goods sold. All right, so that's the trick. So multiply by 365 if that is what is given to you. But if 366 is given to you, multiply by 366. So your answer in here is going to be in days. When you're calculating for your production cycle, the formula is still average work in progress. Okay, the word average means the opening, the closing, and divided by 2. Okay, that's how it is. So your average work in progress, okay, then you divide it by annual cost of sales. That is cost of sales. So your production cycle will be divided by cost of sales, or your production cost, any of it that is given to you. All right, then multiply by 365 days, and you get this answer. All right, then for your finished goods, okay, for your finished goods, going to be average finished inventory, okay, which is the same thing that we have here. All right, average finished inventory divided by annual what? Cost of sales times 365. Please, this thing is not in bracket. Oh, it's not in bracket. That's a mistake. Okay, that's an oversight. Okay, it's not in brackets. You add all together. Add all together to get your total inventory holding period. All right. But if it's a trading company, just use only the finished goods own. Just pick only this finished goods formula. That's what you are going to use direct. So when it's a manufacturing company, ICAN is trying to stress you. But when it's a finished goods, when it's a trading company, just picking the finished goods direct and you're good to go. All right. So how do you compute for your average collection period or your average receivable collection period? So that's the next one. Just use your trade receivables and divide it by credit sales. They multiply by 365 days. Okay, this is the other part of the formula. The formula has inventory, which we have looked at. Then it has receivables, okay, which is the other ratio. So for calculating your receivables, this is it, average receivable collection period. It is called collection period because you collect money from your receivables, okay? So that will be trade receivables divided by credit sales times 365. Sometimes you will not see credit sales in the question. Please use your total sales. Where credit sales is not given to you in the question, please use your total sales figure. That's the trick. So what about the last part, which is average payable period or average time to pay suppliers? The same thing, total payables, which is trade payables, divided by purchases. You are dividing by purchases because you are buying from your creditors. That's why your creditors is divided by purchases. Then multiplied by 365 days. Once you can calculate your payables, calculate your receivables, and calculate your inventories, my brother, my sister, you are good to go. That is all. Add your inventories together with your receivables and deduct your payables, and we are good to go. All right, we are good to go. All right, so this other ratio is also included in your material. They call it sales revenue to net working capital ratio. The name has already spoken for itself. So just put your trade receivables up and put your net working capital down. And how do you get your net working capital? It means total current asset less total current liability. So in case I can say calculate your sales revenue to net working capital ratio, give them this formula and they are good to go. Let them go and sit down. All right. So I'm going to be stopping there for today. Your assignment is going to be for you to read on over trading / under capitalization. The note is already here. Okay, just 2 page. Let's just say 1 page, anyways, because this is already half. So over trading and under capitalization, please read on it and understand what it actually means. If you are doing FRO, you may meet it in FRO. Okay, you may meet it in FRO. And that is the end of working capital theoretically. Okay, theoretically. I have questions to solve, but I'm just going to be solving few questions. Just see, I can't solve this one. It's not possible. I can't solve this one today. So we'll just solve something from ICAN past question and use it to catch fun. Okay, let's use it to catch fun. Okay, let's solve this guy. Let's solve this guy quickly. So this was extracted from your ICAN pack. Now they said example. They gave us for 2007, 2008, and 2009. They gave us inventory figures. They gave us trade receivables figures. They gave us cash figures. So they now give us, if you had all together, that would mean you have your total current assets. If you take out your liability, that will give you your net current assets, okay, which is technically your working capital, isn't it? So in addition, the following information is also available. Now, they gave you figures for credit sales. You are lucky, you are giving credit sales. I told you where credit sales is not given to you, just take it as what? Use your normal sales figure. And you're also giving cost of goods sold. Then I told you required, okay? Assess the entity's liquidity position using inventory turnover period, okay? That is calculate inventory turnover time or turnover period ratio. Calculate the average collection time, that is for receivables because you collect money from them. Then calculate your liquidity ratio. Now, this question can be as simple as this for your examination in FM because I think should not be testing too strong question for the first time. I don't think so. It shouldn't be too strong. So before you start thinking in your mind, would there be something like this? Yes, it can come out, okay, because they are testing it for the first time. So they should be lenient rather than bringing 2 page, 1 page question. So they can bring this anyways. So let's see what we can do. Now, the first thing is that they want us to calculate each of these ratios. How do you go about this? If you don't know the formula, please jump the question because you cannot solve it without the formula. You need the formula to solve it. Okay, so inventory turnover rate time has a formula. The average collection time has a formula. Liquidity ratio also have what formula. Now, the trick here is that sometimes some students are not conversant with the names. A particular ratio can have 3 names, 4 names, depending on how they call it. So a student may just be familiar with one name. He wouldn't know that that same ratio also means something else. So please get familiarized with the names for those ratios. Okay, so look at my solution here. The first one is inventory turnover time. So this is it here. I hope my screen is good. So this is it. Inventory turnover time, which is inventory holding period. Average inventory divided by cost of sales times 365. That's what it means. And I told you that for you to get your average inventory, just simply say your opening inventory plus closing inventory and divide it by 2. Please, can somebody just reply to me on the chat box, say you are following? Let me know whether I'm talking to myself. I don't know. So let's go. Is anybody? Are we still on point? Somebody, please. Anybody? Okay, somebody just
Yes,
replied.
sir.
Okay, somebody just replied.
Yes, sir.
Thank you, sir. So we are solving for inventory turnover time, which is inventory turnover period, whether they use time, whether they use period, that is their business. So just say average inventory divided by cost of sales times 365. What is our average inventory? Now, this is the question. This question gave us for 2007, gave us for 2008, gave us for 2009. But when they say you should calculate this ratio, they did not specify the years you should calculate for. So they didn't specify the years that you should calculate for. So which year should you be calculating for? The simple answer is that I would calculate for 2008 and 2009. Only the first year. If somebody wants to ask, why are you leaving the first year? It's quite too simple, okay? The thing is that first year does not really have opening stock. The first year does not really have all the data that I need. First, that's the first point. Secondly, my credit sales and cost of goods sold started from 2008. Can you see it? 2008. So it therefore means that this 2007 is just for disclosure purpose. Okay, so we shouldn't be calculating for 2007, we should calculate for 2008 and 2009. That's one thing that should come to your head. So let's go down. So for 2009 and for 2008, that's what I'm going to be calculating. Okay, so I need to calculate my average inventory, which is opening inventory plus closing inventory. What is my opening inventory? What is my closing inventory? The rule is that the stock that came from 2008 as closing stock will be 2009 opening stock. Let's go and check. Okay, let's go and check. Okay, so what's the stock? This is it. This is it. Inventory. This is a balance sheet. Oh, okay, this is a balance sheet. This is what we mean by balance sheet extract. And you understand that anything on the balance sheet is closing figure. They don't need to tell you that one. Anything on the balance sheet are all closing figure. That means that this 130 that is here is closing inventory for 2007. This 240 that is here is closing inventory for 2008. And this 225 that is here is closing inventory for 2009. So since 130 is closing inventory for 2007, it should be opening inventory for 2008. Do you agree with me? Okay, if you don't agree with me, it's your business now, Abi? Okay, so that means that...
Yes, sir, we agree, sir.
Okay, so for this 240 now to be closing inventory for 2008, it means that it should be opening inventory for 2009. Do you agree with me on this one too? 2009, opening inventory 240. Good. So since you agree with me, come down to my solution. That's why I have 240 here as opening inventory for 2009, 240. So this 240 is the closing inventory of 2008 that came to what? 2009. What about my closing inventory? The closing inventory for 2009 is 225. Just go and pick it directly. So look at it, 2009 itself, 2009. Just pick the 225 because that's the closing inventory for 2009. Don't go and go in your exam. You have to be very attentive and pay attention to details. 225. So that's how we got that. So we have 240 plus 225 divided by 2. Where's the 2 coming from? Somebody asked me one day, I said, the 2, is it because we're having just opening and closing, like 1, 2? That's why we are dividing by 2. Is that the reason? Then I shook my head and said, oh, Jesus. Anyways, I can't ask you where the 2 is coming from. But the fact is that average of those 2 figures is 2. Okay, so we should just divide it by 2. All right, so just divide it by 2. That is it. So divided by 2, that will give us a figure which I don't know. Then what is my cost of goods sold? What's my cost of sales? Let's go and check. Cost of sales, this is it. It was given to us directly. 1 million, okay, 1,120. 1,000. 209, sorry, 209, 1,200 for 209. Don't, look at me, I want to go.
1, 2.
Look at me, I want to go, and I'm advising you not to go. Okay. So 1,200. Am I making sense? That's our cost of goods sold. Now, be very careful. In some standard questions, they will not even give you cost of sales, but they will give you information to calculate cost of sales. But don't worry, we will solve a question that has that. Okay, we'll solve a question that has that. But this one gave you cost of sales directly, so there's no issues. Now, if you know you have calculator, help me punch 240 plus 225, then divide it by 2, then divide it by 1, 2, and multiply by 365, whether you get this 71 days.
Confirmed, 71 days.
is the only time that I used to hear this woman's voice. Calculator. Confirmed. Confirmed. That is the time that I will hear her voice. But that is good. I have assurance that you always give me figure. So 71 days is confirmed. Thank you very much. So let's do for 208. Okay. So for 208, the same thing. Opening inventory, closing inventory divided by 2. Then you say divided by cost of goods sold. Okay, which is cost of sales. So what will be the opening inventory for 208? It will be the closing inventory of 207 that will come as opening inventory for 208. Okay? So let's go and check it out. So what is that closing inventory for 207? So inventory 207 is 130 closing. So it should come as opening here. So 130. So 130 plus what is 208 closing inventory? 240. So we have 130 and 240. So let's go. So we have 130, we have 240. So divided by 2. So what's our cost of sales? Let's check. That's 1,120, correct? So that's how we have 1,120. We multiply by 365. This question did not tell us that we should use 365. It was silent. I think so. It was silent. I didn't see anything like 365 there. But I am using 365. That is the standard. Except otherwise stated in the question. If they say 366, please use 366. All right. So that is it. So do the mathematics for me, madam.
60
Confirm?
days.
Oh, Jesus.
Yes.
Confirm. So we are good to go. A is settled. So let's go to B, average collection time. Now, when they use the word average collection time, they can outsmart so many students. But me, I know anytime that they are using collection for a ratio, I know it is receivables they are talking about. Because who will you be collecting money from? If not from people that are owing you. So your average collection time is the same thing as your what? Average receivables holding period. Therefore, the formula will now be average receivable divided by credit sales because your receivable came into existence because of sales, which is credit sales. Then multiplied by 365. So how do we get our receivable? It was given to us now. So we'll still do calculate for 209 and calculate for 208. So we have opening receivable plus closing receivable, then we divide it by 2. So let's go and check. The same principle that we used though for inventory, we use the same principle for receivables. So what is the opening receivable for 2009? That would be the closing receivable of 2008. So let's go and check if it is 312. Let's go. So receivable is this guy. All right. So where is it? Okay. So 245. Okay. 209. Okay. Yes. 312 is the closing for 208 that will become opening in 209. So we have 312. Then 400 is the closing for 209. So we need 312 and we need 400. So let's go and get that done. So 312, 400. Add both and divide it by 2. Over what is our credit sales? I think they gave that to us directly. So credit sales, where is you? Where are you? 1530 for 209. Pick it out. 1530. This credit sales and cost of goods sold, they are profit and loss item. So they are not closing stocks. So they are not closing values. They are operating value, meaning value for the year. Value for the year. So 1530. We have that there. So let's go. So can somebody do it for me, madam? Are you there? Then 365. Can somebody help me?
85 days.
25, okay, 85. We are correct.
85 days, yes.
Thank you so much. Okay, so let's do the same thing for 208. For 208, our opening event is going to be 245 because this was the closing inventory 207. Let's go and confirm. So inventory, I say inventory, receivables is 207. This is 245. It's closing for 207, which will become opening in 208. Then 312 is the closing for 208. So let's just pick them out. So we have 245 and 312. Add both together, divided by 2. What's our credit sales? Our credit sales for 208 is 15. To confirm that, this is it here, 15. Credit sales. So let's do that mathematics. Please help me. Plus divided by 2 divided by 15 times 365. What do you have?
68 days.
Oh, you are blessed. 68 days. We are good to go. So we now move to C. The C now says liquidity ratios. Now, they put S ratios. Now, the thing is that liquidity ratio has types. They didn't stipulate the types that we should calculate. But that means that we have to calculate both because they have already put S. So what are the types of liquidity ratio? I made it clear here. We have the current ratio and we have the acid test ratio. So I decided to do both. Okay. So you have to be careful on that. So I did the current ratio and the acid test ratio. Now, what is the current ratio or liquidity ratio formula? It is current asset divided by current liability. Okpari, that's just it. Current asset divided by current liability. And in this question, 207 current asset is 475. Let's check. Look at it now. Current asset, 207, 475. Okay. What was our current liability? 200. So 475 divided by 200. Okay. 475 divided by 200. So let's go and check our solution. 475 divided by 200. Madam, do you get this figure? 2.38. Do you get 2.38? 475 divided by 200.
Yes, sir. Yes, sir. 2.38 times.
Correct.
Yes.
Correct.
It is measured in times. It is measured in times. Okay? It is measured in times. Before you go and put percentage there, I will just hide my face as if I did not see you. It is measured in times. This means that our current assets, okay, is what? 2.3 times over our what? Our liability. Look at it now. You have 475. It can buy your liability more than 2 times because 200 times 2 is 400. And look at 75 is still extra. So it is 2.38 times higher than your current liability. That's what it means. Let's go and look for 208. Sharp, sharp. What's our current asset for 208? Who can help me? 606 divided by 300. 606 divided by 300. What do we have, please?
2.02 times.
Thank you.
2.02 times.
Thank you. So why should do this last one? 648 divided by 450. 648 divided by 450.
1.44 times.
God bless you. We are done. We are done. So
1.44 times.
Last late comma. We are done. So the next one is for us to calculate our quick or acid test ratio because it is a type of liquidity ratio. Now, the formula for acid test ratio is current assets minus closing inventory. They're divided by current liability. We are taking out inventory, closing inventory from this formula. Why? Because we are assuming that closing inventory is not as liquid as we think. This ratio is only used for organizations that know that their stock is not liquid. When I mean their stock is not liquid, it simply means that their stock cannot be easily converted to money. For example, people that deal in cars, okay, many companies that deal in cars, some of their cars can stay there for months. It means that it's not liquid. But you see, fast-moving inventories, hey, like FMCG, hey, they can't use this formula. They can't use quick or acid test ratio. Why? Their inventory moves. This biscuit that you saw now, just go and come back. They collected it. Somebody have bought it. Okay, so don't just calculate ratios. Know the companies or the kind of industry that these ratios will work for and how to interpret the ratios. So your acid test ratio will work for industries, organization that has slow-moving inventory sales. It's as simple as that. So we already know our closing stock. It's already in the question. So what's our current asset? We know it's 475. This is here, 475. 130 is closing inventory for 207. Let's go and confirm. Look at it, inventory closing 207. Just pick it direct, 130. Pick it direct. So once you minus it, okay, then divide it by 200. Can you do it for me? 475 minus 130. The answer that you get divided by your current liability, which is 200. We have it here already before. You get 1.73.
Yes, 1.73 times.
Thank you, madam. So let's do for 208, the same thing. So we'll do our current asset minus our closing inventory. Our current asset is already 606, we know is there. What's our closing inventory? 240. To confirm that, 240 is our closing inventory for 208. So just pick it, 240. So that's how we have it. So do it for me. Divide it by current liability, which is this 300 that is there. That should give you 1.22. Confirmed.
2.2 times.
Thank you. Then finally, let's do that. We already have our 648 here, which is 648. Then this 225 is closing inventory for 209. Let's go and check inventory 209, 225. Oh yeah, help me out. Figure me. 648 minus 225 divided by 450. 0.94 times.
Confirmed.
Confirm. Thank you very much.
Yes.
That is the end with this particular question. I don't think I have the luxury of time. Okay, let's see. I don't think. Oh, is there any questions? Can somebody just ask any question? I think I have.
Yes, I have the question.
You have a question? Oh, yeah, ask.
Yes, sir.
Thank you.
Yes, sir. There was a time I went for an interview and I was asked the difference between current assets on the quick ratio and asset ratio. I didn't really know what to say, but I managed to state the formula. So I want to know the difference between the two ratios, sir.
I think that is what I just explained, though. Abby, can somebody just tell me what I explained now for the difference between current ratio and quick asset test ratio? If not, your background is not noisy. Please, can you assist? Anybody?
Good evening, everyone.
So you said, okay, sorry.
Hello, sir.
You said that
Okay.
current quick acid test is used for products that are not seriously in high demand, while current asset is for products that are seriously in demand. That's the difference.
Thank you. Does anybody have anything that's maybe to commensurate? Any other thing?
Yes, sir.
Yes, sir. I'm with you.
All right. To me, one of the differences is that in quick acid test ratio, we pull out the closing inventory because these are for industries that
We've lost him. We've lost him. Okay. Sorry, we can't hear you, Mr. Jide.
have a over whereby they are capital to cash. And the current asset, the liquid ratio, current ratio is meant for organizations or sectors that their closing stocks doesn't take time to be turned to
cash.
Liquidity. Thank you. To cash.
Okay, thank you so much. So, madam, that's just it. Okay, when you're using the current ratio, we don't take out closing inventory because the assumption is that our inventory are highly liquid. That means to say we can sell them sharp and get money. But when we are using the quick, please, it is not quick acid test though. It is either you call it quick ratio or acid test ratio. Before you say quick acid test ratio, there's, oh Jesus, tautology. So for quick or acid test ratio, we are using it for organizations or industries where their inventory do not, they don't have fast moving inventories. And I'm giving an example like a car dealer, for car dealers, people that sell cars. I like that example because there's a place that I usually pass. I used to see some cars that I've been seeing for like last year or so. The cars are not selling well. Not everybody will buy the cars. So that's just it. So for inventories that are not fast selling, we use your acid test ratio to do that. Okay, to do that. So I think that is all. If you permit me, I'm not forcing you anyways. I will just solve this one. Okay, this one says you calculate the length of the cash operating cycle for the company. This is my solution here. But if there's no time, if we are all tired, we can just call it a day. All right. So maybe we'll meet in our next class. So I don't know. I don't know if we are calling it a day or we are proceeding. Huh?
We are proceeding, sir. We are proceeding, sir.
Okay, on behalf of the Women Affairs, Abby?
Yes, sir.
Yes, so right on.
For the Men Affairs, okay. Okay, the men are not saying anything, but we'll just assume that women are right. Okay, let's just do this one sharp. Sharp, no time. So for this guy, they said we should do something. Please help me mute. The requirement states that calculate the length of the cash operating cycle for the company. I told you, when you are asked to calculate the length of cash operating cycle for a company, you need three things. You need inventory, you need receivables, and you need payables. These are the three major things that you need. Second point is check the question. Is this question for a manufacturing company or a trading company? If it's for a manufacturing company, things get a little bit longer. If it's for a trading company, it gets a little bit easier. So for this question, it's a manufacturing company because I can see raw material, work in progress, and finished goods. So this is for manufacturing company. So they're giving us the breakdown of their inventory. Then this is their trade receivables, and this is their trade payables. Then we have annual purchases, annual cost of sales, and annual sales. There's no issues. Now, if you look at these sales, they do not state credit or cash sales. They just give us sales directly. No wahala. That's what we can do. So they said extract from the statement of financial position, which is known as balance sheet, and income statement of the company as set out below. So these are the inventory, receivables, payables, and these are the other profit and loss account. This one is for balance sheet. Okay, balance sheets. And this one is profit P&L. Okay, so let's do our cash operating cycle. Very simple. So This is cash operating cycle. I put here in days, okay, because I'm going to be measuring it in days. Okay, I'm going to be measuring it in days. All right, I'm going to be measuring it in days. All right, so the first thing you need to do is to calculate for inventory, which you call average inventory holding period. Now, because this is a manufacturing company, you need to calculate for raw material. You also need to calculate for production cycle and calculate for finished goods. For the raw material, the formula is easy. Your raw material divided by your purchases times 365. Now, the formula also states that you can either use average raw material. The only time that you make use of average is when you are giving more than 1 year. For example, in this question, they did not give us more than 1 year. For you to calculate average, you must have opening, closing divided by 2. But here now, there's nothing like years, like year 1, year 2, or 2007, 2008, 2009. So they just give us for only 1 calendar year. So therefore, we don't need to look for average. I don't know if I'm making sense now. We don't need to look for average. Just pick the figure directly. So for our raw material, our figure is 864,000. So pick that out. That will be 864,000 divided by your annual purchases, which has been given to us directly in the question. Why am I going there? Okay, these are our annual purchases. 1,745,000. So just divide it directly. 1,745,000. Then multiply by 365. Anybody? 181? Anybody?
Yes, 181.
Correct, Abby?
Yes,
okay.
sir.
Thank you. So the other one is we are done with raw material. You move to wipe. This one is known as work in progress. So for work in progress, the same thing. Just say your wipe. We don't need to look for average. Just say your wipe divided by, you wipe it, you do it against cost of sales. Okay? You do it against cost of sales. So let's go back to that question. So what's our wipe? This is it. 448128. Bring it, 448128. What's your cost of sales? We have been given already. Here's the guy. Cost of sales. 5,272,128. You get it? 5,272,128. So you help me divide and multiply by 365 days. You get 31.
It's correct, sir.
God bless you, sir. Then the last one is finished goods turnover. So for finished goods, the same thing. Finished goods divided by cost of sales times 365. So let's go and check. Finished goods, this is it. 1,567,893. So let's go and put it there. 1,567,893 divided by cost of sales. This is our cost of sales that we have here. You see the same thing. 5,272,128. Oh, yeah, do it times 365. Do you get 109? 109.
I got 108.
Maybe approximately. 0.1.
I got
That's
108.
108.
109.
You got 109.
Well, I
No,
was
if
expecting
you
0.1.
Okay,
if you
you got
Oh,
approximate,
109.
nine.
give us 109.
Okay,
108.
okay, no problem. 108, 109. We'll just manage it like that. But we understand the
I
taxes.
thought
Okay, so we'll now do this receivable collection period. We are done with everything regarding to inventory. This is it. So let's do our receivable collection period. We already know our receivable divided by credit sales times 365 days. So how much is our receivable? Let's go and check the question. Is it trade receivable? 1,425,600. Oh yeah, copy it, paste it there. 1,425,600. What about our credit sales? Now the thing is that we don't have credit sales, but that does not mean that you will not say, hey, I don't know it. Oh yeah, copy this sales. 5,802,400. So let's go. 5,802,400. Oh yeah, multiply by 365 days. Do you have 90? 90.
Yes, sir. Approximately, sir.
Okay, thank you. So help me do 181, 31, 109, and 90. Add it, whether you get this 411. 181, 31, 109, 90.
$411.
411, sir.
Thank you. So the last part is average payable payment period. This one we are paying our suppliers. So the formula is payables divided by purchases times 365. So what's our payables? Come back to the question. Payables is this guy. 604,800. Copy it, paste it there. 604,800. divided by purchases. What's our purchases? Our purchases 1,745,000. So let's go 1,745,000. Oh yeah, multiplied by 365. Do you have 127?
237.
Oh yeah, minus it. You know you're going to subtract it because it's payable. You are paying them. Minus it, you get 284. 284, Abi?
Yes, 284.
So that 284 is our final answer. Cash operating cycle.
Okay.
Ladies and gentlemen, this brings us to our first class on working capital management. In my next class, I'll be bringing ICAN past question live. I have it here, but I can't solve. Okay, this is it. This is as detailed as it is. So I can't solve. It will take us time, and this is our solution. So in my next class, I'll be attempting this question and also attempting any further question that I can lay my hands on. All right. Thank you so much for staying with me, and thank you so much for your time. I remain Dr. President of Pathfinder College of Management and Accounting. Thank you.